Well, it's a good morning from me and it's a good morning from him, and welcome to my mortgage live stream. I hope you're well. Hope you're enjoying your spring. Spring starts actually on Saturday, I think 1st of March. I'm not sure if that's true or not. I have to look at the weather, don't you? Let's go on air. Should we go on live? So yeah, let's get on with our topics today, and hope all is good. Hope your world is buoyant and bubbly and you're getting busy and all sorts of things like that, and enjoying your financial services career and all those things. Got a couple of great topics for you today. Again, just brushing up on some CeMAP areas for you, just for your CPD. We've got a couple of laws today, so Consumer Rights Act and vulnerable customers. So things you might not want to pick up and read about if by choice, but things that you do need to know about. So we've got that coming up for you. And we've got a lovely little coaching tip for you, for those of you that do coaching, particularly because financial advisors, mortgage advisors, you do coaching. It's how you deal with customers. You may not think you're a coach, but you are. Anyway, enough of that. Let's head over to the whiteboard for our first session for you. So I want to take a look at the couple of the laws and things that crop up in CeMAP. A few things change, don't they? A few things need updating, and that's why we're doing what we're doing for you as well. So let's pop across. Let's pop over to this whiteboard here, where I've already started. As you can see here, I've already begun my my topic, Consumer Rights Act 2015. So, decade ago now, this is all about consumer protection. So let's just draw a little shield, shall we? Because that's what this one's about. This is all about the consumer, people like you and I, and it's all about protection. Now, of course, our regulator's there to protect consumers. Of course it is, but we're talking about other things here, not just regulated products. Now, when it comes to consumer protection, there's three areas which the Consumer Rights Act focuses on. Traditionally, it looks after goods, so products themselves. So let's just draw a picture of a laptop here, which is something you've bought from Currys. The little mouse there for you, and it's a product which you've bought. Now, that's those areas have always been looked after with consumer protection, and rightfully so. And this act doesn't really do a lot different really for those. It looks at making sure that the product is good quality, making sure that the product is fit for purpose. Let's put that up there for you. Fit for purpose. There you go. Of course, like all good things as well, if it's not good, it's not as described. There you go. That's another key one there for you. Not as described. Then you've got a 30-day refund as well. So let's put in there 30-day refund. Pretty standard fare, really, when it comes to it. The second area, which is relatively new, let's just put up here for you, is services. We're talking about goods and services. Now, services have always been looked after. People buy a service, don't they? So whatever you want to do for service. So I don't know, let's just take a look at, you're buying some lawyering, You're buying a lawyer. I think that's a good picture there of the legal scales of justice. Of course, if you're going to be buying a service, again, it needs to be top notch. It needs to be fit for purpose. All those good things. So, but there's three areas for that. Let's just put a colour red in there again for you. When it comes to a service, it's got to be delivered as promised. That's the key word there. Delivered as promised. Because obviously goods get bought and used, services get provided, delivered, don't they? It's got to be delivered with good skill and care. Of course, makes sense if you think about it. So once you've decided on what you want, it's got to be delivered properly as well. And it's got to be a fair price as well, which is an interesting one, isn't it? A fair price. That's been affecting the financial services sector quite a lot recently as well. So that's services. Now, the one that's new is digital content. So let's give that its own section, shall we? Let's just put that across here so we can see where we go with our pictures here. We're talking about digital content. Now, of course, everybody buys stuff online, but we're not generally talking about that because you buy goods online, services online. I'm talking about a digital piece of content that you download to consume. So, for example, my son's a big gamer, so I would talk about computer games would be an example. It might be software that you've downloaded. It might be music, of course. Well, people tend to stream that sort of stuff nowadays, isn't it? So anything online courses is a digital content, and these are treated slightly differently in a way. First of all, it is the first ever law that's been brought in for first law for digital content. It's never really been protected. The consumer's never really been protected in this area as well before. couple of things for you. First of all, if you download the stuff and it damages your PC, then you can be covered for that. Now, I'm not talking about breaks it. I'm talking about software, and I'm talking about Trojans and viruses, that sort of thing as well. And obviously, if it's not working, if it's faulty, not fit for purpose, not described properly, of course, because it can also be a service, can't it? Then, of course, you can be covered under the rules as well. So they're the three areas which the Consumer Rights Act covers. So let's just put those across there so you can distinguish those three with my lovely little pictures. So what else does it do? Well, what it tries to do, of course, it tries to prevent disputes. And obviously, you can have refunds, and you go back to the customer, to the provider, and you get your refunds or replacement, whatever it is. But if there's a bigger dispute going on, so let's talk about disputes, shall we? What it tries to encourage under the new law is what they call this alternative dispute resolution, or ADR. Don't we love an acronym? So an alternative, so it's a different way of handling a dispute, is what they're coming. Alternative dispute resolution. Let's just put all the words in there for you. Resolution. Or ADR, which you'll see in the exam. That's the sort of thing you'll get for you. Well, what are they trying to do there? Well, they're trying to get you to do it or to resolve the problem differently. In financial services, of course, we've got our own complaints procedures and ombudsmans and all those sort of things. But in this world, it's slightly different. Here you've got three areas, really. You've got mediation with a third party might solve the issue. You've got adjudication, as they like to call it, adjudication. Now this looks at some case studies or previous rulings that have been done. And the third one, this is when they get the courts involved in, that's arbitration. And that's when the courts become involved as well. Obviously, they want to keep it out of the courts because that's expensive for everybody. So that's the alternative dispute resolution that they've got for you as well. A couple other things for you in these rules. So let's just draw a little line here. There's quite a lot going on here, isn't it? A couple other things for you in this one. First of all, when it comes to contracts, they do look at fair contracts. So if you're organising a service, which of course has a contract attached to it, contracts need to be fair. There is a separate contract law, of course, but under the Consumer Rights Act, contracts are also covered. They need to be clear, fair, and good faith. And they also talk about unfair terms. There you go, unfair terms, which is another part of the Act as well, where the terms of the contract. So let's just do a little picture of a contract there for you. So the contract has all the details and signature, etc. on. So any unfair terms need to be made sure they are correct. So no hidden costs, no scope creep, as I call it. Builders have this problem, don't they? When you agree to get a builder into your house, then you've agreed a service. Now, as soon as the builder walks in, the man of the house or the woman of the house says, "Look, can you do this for me while you're here? While you got your ladder, can you sort that out on the roof?" It's called scope creep. Obviously, that's from the customer's point of view, but if the provider of the services does that, it's not good. So contracts need to be clear, fair, good faith, no scope creep, no hidden costs, all those good things, no unfair terms. And that, of course, affects services effectively. So there we have it. A bit of a nutshell for you. Consumer Rights Act. Hope that's been useful. Bye. Good work all around. Okay, so that's our first act for you. What I want to do is take a look at more mortgage related next, and we can come on to that now for you. So we're going to go over to the same whiteboard actually, because I need a bit of space this one, so I'm going to rub this out while I have a little chat with you to see if you're okay, life is treating you well, you enjoyed the weather at the weekend, although we did have a bit of a storm actually as well. It's the 1st of March on Saturday, so spring is in the air, because apparently 1st of March is, I think it's the official start of the spring, isn't it, when it comes to it. Anyway, let's take a look at the FCA's, our lovely regulator, of course, and how they look after two particular types of customer. special customers of the FCA. There's two of them here. There's mortgage prisoners and there's vulnerable clients. And they put a lot of emphasis on these types of customers, the FCA, because they're worried about the two of them. So we're talking about the FCA requirement here. We're talking about special customers. Now, the first one I mentioned to you is mortgage prisoners. So let's put them up there for you. Now, what is a mortgage prisoner? It sounds awful, doesn't it? It's anybody that's got a 25-year mortgage for the rest of their life. No, it's not like that at all. A mortgage prisoner comes from a bit of history, really. This is somebody who has taken out a loan in the past with whatever terms and conditions, and now they find themselves stuck with that loan. Happened a lot in the financial crash. Back in 2008, we had a number of institutions that were bankrolled, if you like, by the government, and they were therefore nationalised, and they stopped lending. The Northern Rock was one, the Bradford and Bingley, Mortgage Express. There's a few examples there where people would have had mortgages with those institutions, but because they were nationalised by the government, effectively, they stopped lending, and their terms and conditions became quite onerous. But what it meant, you see, is that these people were stuck with a mortgage contract that wasn't particularly very good for them, maybe a high interest rate or something, but they couldn't come out of it. Why couldn't they come out of it? Well, predominantly it was that the mortgage that they had, the mortgage terms that they had, were pretty onerous. You know, they weren't good. Now, why is this? Well, they may have high interest rates, or they may be trapped by the lender. But what they have problems with is switching or remortgaging to another lender. That's the problem they started to have. Because when they borrowed the money in the first place, they were given like easy peasy terms and conditions. I often joke that people with mortgage lending before the financial crash, as long as you had a pulse, then they'd lend you the money. I mean, you might, for example, have had somebody who used self-certification, of course, or non-status. They might have gone for 100% mortgage, because they were pretty commonplace, weren't they, before the financial crash. They might have had an interest-only mortgage with no repayment vehicle. These are very common before the financial crash as well. They might have had a non-status or some kind of crazy status mortgage. So if they decide to switch to another lender, the other lender is going to say, no, under our current terms and conditions, you ain't going to get a mortgage with us. And that's the problem. So the FCA did bring in MCOB 11, which is designed to help people switching mortgages to other lenders. You know, obviously, we've got a new affordability rules came in 2014. And so switching was very difficult. But they did bring in there, if you switch to another mortgage scheme without borrowing any more money, you didn't need to have an affordability, which is why fixed rate mortgages, when they come to an end, the lender doesn't go through an affordability check. But remortgaging to another lender is a different kettle of fish altogether. So a lot of these mortgage prisoners are stuck. Now, one by one, they're starting to be released from their prison because new lenders are coming in with new terms and conditions and affordability requirements. But there's still quite a few people stuck on these very old mortgages on massively high variable rates now, because there's no fixed rates offered to them, because these lenders aren't lending anymore. That's the problem. They're just trying to wrap up their mortgage book. They can't sell it on. So there still are quite a lot of mortgage prisoners. So you often hear the FCA talking about how they can rescue mortgage prisoners. Now, one of the things that's going to rescue these guys is the later life lending market, which of course has exploded in the last few years with different types of products. So you're talking people borrowing over the age of 50. So for example, somebody on an interest-only mortgage who's now in their late 50s, they can't remortgage to a normal lender because they'll want the mortgage paid off, roughly around retirement. But if you go to a later life lending specialist, somebody like, Livermore, somebody like that, they will lend on to 80 or 90 ages. So there's many new products coming in now to rescue these mortgage prisoners. Anyway, that's the first category of customer, which we know and love. Now, the second category of customer, I think, is really important. I really do. And that's what we like to call the vulnerable customer. So let's just put that up there in black for you. The vulnerable customer. I'm sure you've heard of this in your reading. Vulnerable customer. Yeah. It's been talked about for ages now, and the FCA, of course, putting a lot of effort on it. They want firms to prove what they do. So first of all, what is a vulnerable customer? Well, a vulnerable customer has its definition from the FCA. It's pretty much somebody who's at risk of harm by the situation or circumstances they find themselves in. They're of risk of harm and susceptible to sharp practices. That's my definition, really. The FCA's got their own. So somebody's situational circumstances means that they are susceptible to mis-selling or some kind of harm when it comes to financial services. So what are the four drivers for this then? Well, there's four elements here, aren't there, of people, four types of vulnerable customer according to their circumstances. The first one is their health. Now, somebody has ill health, mental health maybe, that could make them susceptible to harm, because if they don't understand, for example, or their illness doesn't give them the ability to understand things or whatever, health itself can be an issue. It could just be a physical ailment that's causing them issues as well. Life events is the other one. Life events. Now, life events could certainly cause somebody to be vulnerable. Divorce, death of a family member. These life events can affect somebody's mental health quite considerably, and that in itself can be an issue that can cause them vulnerability. Somebody with low capacity or capacity to understand things, maybe English is not their first language, that sort of thing. Low capacity can make somebody susceptible to harm. And the last one is low resilience, caused by a number of factors, really. It could just be general mental health, it could be the conditions they find themselves in, education, whatever. And these things affect people and their vulnerability. Now, the whole point, remember, is that somebody, due to their situation, circumstances, is susceptible to harm. So firms have to make sure they look after particular vulnerable customers. You should look after your customers anyway, and good advisors are able to suss people out and handle people uniquely. But firms have a number of things they have to do. So let's talk about these. These are really important. This is where the FCA is really trying to find out what firms have done to handle their vulnerable customers. First of all, the firm has to understand their customer base. They have to understand their customers to ensure that they're able to define whether they are vulnerable for whatever reason. So they have to do things to actually, find out a little bit more about their customers and their vulnerability. They then have to train their staff. Now, this is a key one. This training has been cut back over the last few years since the big organisations have pulled out of financial advice. And a lot of the smaller firms now, they do have training. Training budgets aren't as high as they should be. But what they should be doing here is training staff to spot vulnerability, but that's down to processes and procedures. But then how do you handle people, for example, who has a low capacity? Somebody who's not quite the same intelligence levels as you. How do you deal with that? How do you talk to them? How do you communicate? Many advisors, mortgage and protection financial advisors, are very good technically, and many of them are very good personally. Empathy, EQ, emotional intelligence comes to mind. That's where the area that they need to train people, particularly as AI starts to take over a lot of the technical stuff as well. You do also need to design the right products and services. So design the right products, that's of course down to the product providers. The services, of course, is down to the advisory firm, which can be flexible according to the person's vulnerability. So you've got to flex the product or service to meet the person. So for example, if you have video-based financial advice, if the customer needs a face-to-face communication, then you need to be able to flex to do that. It may not be you that does it, you might refer to somebody that does, but you do need to be able to handle that side of things as well. And of course, when it comes to processes and procedures, that's the big thing. It's all about procedures nowadays. We all try and cut costs with processes and procedures. And are your procedures good enough to cope with different types of vulnerable customer? I mean, I was on the phone to my insurance company, I won't mention who they were, at the weekend, and you can't talk to people. You have to use the chat box. Trying to get a phone number, you have to Google it. It's not on the website. The chat boxes are a nightmare. It's all done by AI. And you have to fit a certain type, don't you, to get the right answers. If it's unusual, you can't talk to anybody. When you do talk to somebody, you go through waiting systems, and it really is quite frustrating for lots of people. Anyway, enough of that. We could talk about that forever, couldn't we? We're not going to. Now, the FCA, when it comes to mortgage lending, does actually have four types of mortgage borrower who they automatically make vulnerable. They are just automatically vulnerable. So you need to be aware of these four as well. So let's put another box here. And these are the four types of borrower who are automatically vulnerable. The first one is a right to buy. Don't get so many of those these days. That's when somebody buys their council house or their local authority or the housing association property with a discount called right to buy. For some reason, they've made them vulnerable. My mum and dad bought our council house back in the 80s. They weren't particularly vulnerable. There you go. I don't think Angela Rayner was vulnerable when she bought her council house a few years ago either. But anyway, equity release is another one. If it's an equity release client, they are automatically vulnerable. And fair play. You can't argue with that to a certain degree. By being vulnerable, it doesn't mean that they are, low capacity or low intelligence or something, or they've got dementia. I'm not talking about that. Often it's a case that if they're desperate for the money, and that's the next one, debt consolidation. Debt con, we call that. I'll put the proper word in there for you. It's consolidation or debt con. This is somebody that's got a lot of unsecured debt, which they've got out of control and they can't deal with it. The interest rates are high and they want to pay it all off with a mortgage, which of course has a lower interest rate secured against the property. That's the key thing. Now, those people are often desperate for a solution to their problem. And that desperation can make them vulnerable because they're then susceptible to harm. If you get a sort of sharp advisor who wants to try and sell them things quickly and get a big proc fee or whatever, then that person will probably go along with the first option they've got because they haven't got many options, you see. That's the whole point behind it. And the last one is sale and rent back. And if you read about that, that's to do with people who can't afford their mortgage. So they sell their house just to an organisation who then rents the house back to them. It's like the opposite, isn't it? So doing these things backwards because they can't afford the mortgage payment. So they sell the house to somebody, get their equity, and they rent it back from that organisation. Those people are definitely vulnerable because they're desperate. If you lose your house because you can't afford your mortgage payments, you're going to be desperate, aren't you? And it's desperation that makes them of a risk of harm when it comes to vulnerable customers. So that's vulnerable customers. It's been around for a long while now. It's only just been recently pushed by the FCA to make sure firms train people, design products, etc. They have to prove that as well with their procedures, and rightfully so. This is all about dealing with people. And when you deal with people, you will come across all sorts of shapes and sizes and characters. In my career of 40 years, I've met thousands of different types of customers. I'm quite good at adapting myself according to people. That comes from life experience and learning about advising. But vulnerable customers, really important. So these are the two types of customers that the FCA put special emphasis on, and rightfully so. Hope that's been useful. Bye. Hey, well done, well done, well done. Okay, well, let's finish off then our live stream today by taking a look at a coaching technique for you. And this is a technique you can use as an advisor as well as a manager when you're coaching people. And I call this one, What is Your Vanilla State of Mind? Is my title. Now, my favourite ice cream flavour is vanilla. I know it's unexciting, a bit dull, a bit ordinary, but I actually really like it. I also prefer white walls, maybe apple white, but any ordinary white colour suits me. I also stick to black coffee. No syrups, no whipped cream, no fancy oat milk or cinnamon dust on my coffee. Thank you. I love to start writing articles with a plain piece of paper. That gives me plenty of options to be able to write and write well. Now, I call this a vanilla state of mind. Now, in coaching or advising, this suggests neutrality, openness, and a blank state for exploration. The state of mind is jolly valuable in coaching for several ways. Well, first of all, it makes you curious. It stops you judging the coachee or the customer. Coachees love a neutral environment. It helps you truly listen. I mean, really listen. Also, it helps you freewheel the conversation without a rigid agenda. It relaxes everyone, you included. And finally, it uncovers all sorts of perspectives. So next time you're tempted to jump in with assumptions and judgment, channel your inner vanilla. I love that phrase, because when you start with a blank slate, you can add all the sprinkles and toppings you want, and that's where the magic happens. Hope you enjoyed that as well. There you go. All right, so let's wrap up the live stream. A couple of useful topics there on vulnerability and the Consumer Rights Act. So not exactly very exciting, are they? But you need to know about them and you need to update yourself, and that's what we're doing these live streams for. Got a couple of live streams in March. Got a couple of people coming online with me where I'll be chatting to them about how they operate. A couple of really good mortgage and protection advisors who work well in the business protection market. So I'm going to have a chat with them how they operate. So that might be quite a useful conversation. Rather than hearing my voice all the time, you'll get to hear somebody else's as well. And we'll do it live on this live stream with video as well. Other than that, I hope you have a fantastic week. Enjoy the warm weather that's coming along. I think it's coming along anyway, and all good when it comes to that. Remember to log on to our Mortgage Advisor Development Hub, as you can see there, to make sure that to use that QR code. Get on our mailing system. Got a few things coming up in the springtime. Other than that, I hope you have a fantastic rest of the day. Enjoy your weekend, everybody, and I'll see you next week. Bye for now.